Okay, let's unpack this. Picture the scene. It's January 2026.
Mm-hmm.
You looked at the global financial landscape and decentralized finance DeFi.
Mm.
It isn't just some niche science experiment anymore.
Oh, not at all. We are talking about a massive financial engine. The rails are built. The
Yeah.
total value locked is, what, well over $200 billion at this point?
It's a whole economy unto itself.
Absolutely.
But, and this is a big but, if you actually scratch the surface,
Yeah.
it still feels like we haven't quite shaken off that Wild West reputation.
It really does. You know, SEC Chair Gary Gensler, he famously compared the crypto market to the Wild West years ago.
Right, warning about investor protection.
Exactly. And looking at the landscape now, in 2026, despite all the shiny interfaces and the apps, that analogy, it still holds a surprising amount of water.
Because even though the tech has matured, we have faster chains, better wallets, the fundamental game of how do I make money versus, how do we get fleeced?
That hasn't really changed. It's just gotten more efficient.
So today, we are going on a deep dive into two specific beasts of this ecosystem. First, the siren song of yield farming. Those passive income strategies promising just massive returns.
And second, the invisible predator in the water, MEV, maximal extractable value, the algorithm that profits from how your transactions are ordered.
Exactly. And the mission for this deep dive is to look past those flashy headline yields, the banners promising 1,000% APY.
Right, and to understand the actual mechanics.
Yeah.
So we've got a fascinating stack of sources today, including a really rigorous academic study on yield farming on PancakeSwap.
And a technical guide to MEV from Arkham Intelligence.
And just to set the stage, we aren't here to hype anything up or, tear it down. We're just looking at the math.
How is the money actually made? And maybe more importantly, how is it lost?
Precisely.
So let's start with that shiny object, yield farming. I feel like everyone's heard the term, but if you actually had to explain it, what are we really doing here? Give us the plain English version.
Think of it as a modern, decentralized version of securities lending. But instead of lending stocks to a broker, you're lending crypto to a robot.
An automated market maker.
Exactly. And it's a two-step process. This is where people often get tripped up.
Okay, walk us through it, because it's not just deposit and earn, is it?
No, it's a bit of a Russian nesting doll situation. Step one is liquidity provision. Let's say you have some Ethereum, some ETH, and some Binance coin, BNB.
Okay.
You want to put them to work. You deposit an equal value of both into a liquidity pool. This big pile of money helps other people trade between ETH and BNB.
So step one, I'm providing the cash for the exchange to run. I'm being the market.
You are the liquidity, correct. And in exchange, the protocol gives you a receipt. It's called an LP token. Think of it like a claim check at a coat check.
I needed to get my money back.
You do. Now, a lot of people stop there. They think they're farming. They're not.
They just have the coat check ticket.
Exactly. Step two is the actual farming. You take that receipt, the LP token, and you lock that away in a separate contract called a farm.
Okay.
In exchange for doing that, the platform pays you extra rewards, usually in their own token. In our case study of PancakeSwap, that reward is the cake token.
So I deposit my crypto to get a receipt, then I deposit the receipt to get the rewards.
Precisely. And that second layer, those cake rewards, that is where those crazy percentage rates come from, the headline yields.
And the study we're looking at focuses on PancakeSwap, on Binance Smart Chain. Why there? Why not, the big one, Ethereum and Uniswap?
It's the perfect laboratory for understanding the average investor. See, Ethereum mainnet has become a playground for whales.
Because the fees are so high.
Insanely high. Binance Smart Chain, or BSC, it positioned itself as the retail chain. It's faster, it's cheaper, it's where regular folks go because they aren't paying $50 just to click approve.
So it attracts the people who look at the S&P 500 doing, 10% a year and think, why would I bother when they see a farm offering triple digits?
Exactly that. The study found that annualized yields on these farms often exceed 100%. In the short term, they can hit thousands of a percent. On the surface, it looks like a money printer.
Free money.
Looks like it.
And here's where it gets really interesting, because we both know if it looks too good to be true,
It usually is.
the sources break down the actual returns versus the advertised returns.
Yeah.
What's the reality check here?
The reality is a bit of a bucket of cold water.
Yeah.
The academic paper makes this crucial distinction between raw returns, which, look great.
Comparable to just holding Bitcoin in a bull run, right?
Yeah, in that ballpark.
Yeah.
But then you have risk-adjusted returns. And when you factor in the risks you took and the costs you paid, The picture changes completely.
So let's break down the P&L. If I'm a farmer, where's my profit actually coming from?
It comes from 3 buckets. First, and this is usually the biggest, the farm yields, the free cake tokens they give you.
Okay.
Second, capital gains. The price of the ETH and BNB you deposited just going up because the market is hot.
And the third?
Trading fees. The pennies you earn every time someone swaps in your pool. But surprisingly, the study shows this is a tiny slice of the pie. Almost negligible.
Okay, so I'm earning tokens. The market's hopefully going up.
Yeah.
What eats the profit? What are these hidden killers the headline doesn't show?
The first one is mundane, but it is deadly for the retail guy. Gas fees.
Wait, but we just said Binance Smart Chain is cheap.
Cheap is relative. We aren't talking about one payment. A full round trip of yield farming, depositing, approving, staking, harvesting, unstaking, withdrawing.
All of that.
The study estimates it takes about 12 separate transactions.
12.
12. You have to approve the token spend, deposit the token, approve the LP token spend, stake the LP, and then do it all in reverse to get out. Even if each click is only $1 or $2, that adds up. 20, 30, maybe $50.
Which doesn't sound like much if you're moving millions.
But this is the retail chain, remember. The data uncovered a massive small investor trap. If you're investing under a certain threshold, say the $1,000 to $5,000 range,
Right.
those fixed gas costs can eat your entire profit.
So you could pick a winning farm, the price goes up, the yield is paid out, but because you only put in $1,000, you end up with net negative returns, just from costs.
Exactly. It's like buying a $5 sandwich but paying a $50 delivery fee. The math just doesn't work for the little guy. The study explicitly shows it.
Okay, so small fish get crushed by flat fees. What about the big guys? The whales, with $10 million. Surely they crush it.
You'd think so, but they have the opposite problem. They suffer from price impact or slippage.
They're too fat for the door.
Right. When a whale tries to dump $10 million into a farm, they move the market against themselves. They push the price up when they buy in, and they crash it when they try to leave.
So they lose a percentage on both ends.
Yeah, because there isn't enough liquidity to absorb their size without leaving the price.
So, small investors die by fees, whales die by slippage. Is there a Goldilocks zone? Is there a way to actually win?
The data actually found a sweet spot. If you want the best risk-adjusted returns, looking at the Sharpe ratio, which is return per unit of risk, you need to be investing between $100,000 and $1 million.
Wow. So to win at this game that's marketed to retail, you need $100,000 in liquid crypto just to start.
It creates this barrier to entry that is just not advertised. It implies that DeFi, at least in this form, isn't the great equalizer it promised to be. It's still a game where capital favors those who already have it.
And we haven't even touched the biggest bogeyman of them all, impermanent loss. This is the concept that just breaks people's brains.
It is the hardest concept to get your head around, but it is absolutely essential.
So let's try to simplify it.
Okay, remember you deposited 2 tokens, ETH and BNB. The automated market maker, the robot, is designed to keep the value of those 2 sides equal. Always 50-50.
Right.
So imagine ETH just rockets up in price and BNB stays flat. The pool is now unbalanced. The ETH side is worth too much. So the robot automatically sells your expensive ETH and buys more of the cheap BNB to get back to that 50-50 value.
So it's selling my winners.
It is systematically selling the asset that is performing well to buy the one that's lagging. You are, in effect, shorting volatility.
So if I just held the ETH in my wallet, I would have all that upside. But because I farmed it, the robot sold it off as it went up.
Correct. And that difference between what I have now and what I would have had if I just held, that's impermanent loss.
Why do they call it impermanent? That sounds kind of comforting.
It's a very misleading term. It's impermanent because if the prices go back to the exact ratio they were when you started, the loss disappears. But if you withdraw your money while the prices are different, which you almost always do, that loss becomes very, very permanent.
So the farming rewards, the cake tokens, have to be valuable enough to offset the fact that the robot is constantly selling your winners.
That is the bet you're making. And in a volatile market where prices swing 20% in a day, that is a very hard bet to win.
Which leads us into the psychology of it all. You look at these risks, fees, slippage, impermanent loss, and you have to wonder, are investors actually navigating this well?
The behavioral data in the sources is, well, it's not flattering. It paints a picture of what the researchers call unsophisticated behavioral.
Give me an example of us humans being bad at this.
There was a migration event on PancakeSwap. They moved from version 1 to version 2. Better security, better incentives, a complete no-brainer to move your money. If you stayed in V1, you were just losing money. The incentives stopped.
And what did people do?
A massive chunk of liquidity just sat there. In version 1, inertia. People set it and forget it.
They treated a high-risk, high-maintenance financial product like a savings account. That's terrifying.
It gets worse. We found something called the staking gap. The data shows a significant number of users complete step 1. They provide liquidity. They get the LP token.
But they never do step 2.
Never. They forget to stake it in the farm.
No way. So they're taking all the risk of impermanent loss, paying the gas fees, but they aren't getting any of the cake rewards.
0 rewards. They're leaving free money on the table because the interface or the process is just too confusing.
That is tragic. And there was one more behavioral trap-chasing yield.
Aking in, as the culture calls it, investors flock to the farms with the highest advertised APRs. If a farm says 500% yield, money just floods in. But the data shows this is a huge contrarian signal.
How so?
High inflows predict negative future returns. It makes sense if you think about it, right? As more money floods in, the reward pie gets split among more people, so the yield crashes.
And all those people start selling the reward token to cash out.
Which crashes the price.
Oh.
So if you see the crowd running toward a farm, you should probably be running the other way. You're the exit liquidity.
So yield farming is a battlefield where you need scale, timing, and constant vigilance to win. But that's just the risk you take. Now I want to pivot to the risks you suffer, the risks you don't even see coming.
We're entering the dark forest. Let's talk about MEV.
MEV, maximal extractable value. The Arkham Guide calls it the invisible tax. This isn't about market mechanics. This is about infrastructure. So what is it?
At its core, MEV is profit extracted by the people, or really the bots, who run the blockchain infrastructure. It's profit made by their ability to see the future.
See the future. That sounds mystical.
Well, the immediate future. When you click swap on your wallet, your transaction doesn't happen instantly. It goes into a public waiting room. The mempool. It sits there, visible to everyone, waiting for a validator to pick it up.
And while I'm in the waiting room, the predators are watching through the glass.
Exactly. Searchers, these highly sophisticated algorithms, are scanning that waiting room. If they see you making a big trade, that will move the price. They attack.
So walk us through the sandwich attack. The guide uses Alice and Bob, which helps.
Right. So Alice wants to buy a meme token. Let's call it PEE. She puts in a big order. Bob's bot sees this pending transaction in the mempool.
And Bob knows her buy is large enough to push the price up.
Exactly. So Bob creates his own buy order, but he pays a higher gas fee. A bribe, essentially, to let him cut in line. He buys PEPE immediately before Alice.
Okay, so Bob buys low. Then my trade, Alice's trade, goes through.
Your trade goes through, but because Bob just bought some of the liquidity, the price is already a little higher than you expected. You pay more. Your trade pushes the price up even further. And then, right after you,
Bob sells.
Bob sells his PEPE. He sandwiched you, bought before you, sold after you, and pocketed the difference.
And me, Alice, I just got a slightly worse price. I might lose 1 or 2%. I might not even notice.
And that's why it's an invisible tax. But across billions of dollars of volume, these bots are extracting millions.
It sounds like rigged markets. It sounds like front running on Wall Street.
It is very similar, and it creates these negative externalities for everyone, not just the victim. It leads to gas wars.
Explain that.
Well, Bob isn't the only bot watching. Charlie is watching too. When they both see Alice's juicy trade, they fight each other to be the one to sandwich her. They keep bidding up the gas price.
Which spikes the transaction fees for the entire network.
Exactly. So even if I'm just trying to send some money to my mom, I'm paying $20 because Bob and Charlie are fighting over Alice. It just congests the chain.
Is all MEV bad? Or is there a bright side?
It's nuanced. There is good MEV. For example, arbitrage. If Bitcoin is $50,000 on one exchange and $50,000 and $100 on another.
Dots will race to equalize that.
And that keeps the market efficient. That's generally seen as healthy. And liquidations, too.
Right.
They're sort of a necessary evil. If a loan is underwater, a bot triggers the liquidation to keep the protocols solvent. It's harsh, but it prevents bad debt from wrecking the system. But sandwich attacks, that is purely extractive.
So if I'm the learner listening to this, how do I not get eaten? Do I need to learn to code?
You need armor. And fortunately, by 2026, the armor has gotten pretty good. The first strategy is hiding. You can use private RPCs.
Break that down.
Normally, your wallet just broadcasts your trade to the public mempool. But services like Flashbots let you send your transaction directly to a validator through a private channel.
Like sliding an envelope under the door instead of shouting it in the lobby.
Exactly. The bots can't sandwich what they can't see.
That seems like something that should just be the default setting on every wallet.
It's becoming more common. Another solution mentioned in the sources is using DX aggregators or batch auctions like CowSwap.
Cattle swap.
Yeah.
Like the animal.
COW, coincidence of wants. It's a clever mechanism. Instead of processing trades one by one, which makes them easy to sandwich, CowSwap batches everyone's trades together.
Strength in numbers.
Precisely. It matches buyers and sellers directly off-chain and then just settles the net result on-chain. It makes that ordering manipulation mathematically much, much harder.
And then there are structural changes. The sources mention PBS proposer builder separation.
Yeah, we love a good acronym. It's an architectural change to Ethereum that became widely adopted around 2025. It separates the role of the person who builds the block from the person who validates it.
Why does that help?
Well, before, the validators could build their own blocks and just easily insert their own front-running transactions. PBS splits that job. The builders focus on organizing the block to maximize revenue, and the validators just check the work.
So it doesn't stop the extraction, it just shares the loot.
In a way, yes. The idea is to distribute the rewards from MEV more fairly, so the value flows back to the stakers, the people securing the network, not just to sophisticated insiders. It democratizes the plunder, if you will.
That's better, I guess.
It's more equitable, at least. But it doesn't change the fact that the transaction is still being exploited.
So let's zoom out. We've looked at yield farming, where you need to be rich to beat the fees and smart enough to avoid the traps. We've looked at MEV, where robots are trying to front-run your every move. It really brings us back to that Wild West idea.
It does. The synthesis of our sources suggests that DeFi in 2026 is this constant game of returns versus costs. On one side, you have the yield, the promise of growth. On the other, you have gas fees, slippage, impermanent loss, and MEV all chipping away at it.
And the winner is the one who can optimize that equation.
Or the one who builds the bots that play the game.
That's a sobering thought. Before we wrap up, is there a bigger picture takeaway here? What does all this complexity say about the state of crypto?
I think there is a provocative question we need to ask ourselves about the true nature of decentralization. Why did we build these systems in the first place?
To remove the middlemen, to fire the bankers, be your own bank.
Right. But look at the reality we just described. Have we actually removed the intermediaries? Or have we just replaced the banker in the suit with the block builder and the MEV bot?
That is a fascinating way to look at it.
The intermediaries are gone in the traditional sense. There's no branch manager to deny your loan. But the extraction of value from the little guy remains. It's just algorithmic now. The tax is still there. It's just coded into the block itself.
We fired the banker and hired a bot, and the bot might be even more ruthless because you can't argue with code. That is something to chew on.
It certainly is.
Thank you for joining us on this deep dive into the mechanics of 2026 DeFi. Hopefully your armor is a little tighter now. Stay curious, stay safe, and watch out for those sandwiches.